Hey everyone, welcome back to our channel. If you're passionate about finance, technology, or just curious about how the world is changing with blockchain, you're in the right place. Today, we're diving into a fascinating topic that blends the worlds of finance and technology, DeFi insurance. Have you ever wondered how insurance works in a decentralized finance ecosystem? Well, you're about to find out. So, grab your favorite drink, settle in, and let's get started. Now, you might be asking yourself, what exactly is DeFi insurance, and how does it function in this new financial landscape? Great question. Let's break it down. First, let's define what we mean by DeFi. DeFi, or decentralized finance, refers to a financial system built on blockchain technology that aims to recreate traditional financial instruments like lending, borrowing, and trading without the need for intermediaries like banks. Now, when we talk about insurance within this decentralized framework, we are looking at a new way to protect assets and investments against risks, such as hacks or failures in smart contracts. Traditional insurance often involves lengthy processes, bureaucratic red tape, and a lack of transparency. In contrast, DeFi insurance strives to make these processes faster, more transparent, and more accessible to everyone. So, how does it work? Let's explore some essential components and examples to illustrate the concept. In DeFi insurance, risk is managed through a mechanism called risk pools. This is where participants contribute funds into a pool, which is then used to cover potential losses for those who experience an insured event. Think of it as a community of individuals coming together to support one another against unforeseen risks. For instance, a DeFi insurance protocol might allow users to deposit Ether into a risk pool. If a participant in a pool faces a loss, say their funds were hacked, the insurance protocol uses the pooled funds to compensate them. This process is governed by smart contracts, which are self-executing contracts with the terms of the agreement directly written into code. These smart contracts ensure that payouts are automatic and transparent, minimizing the need for third-party involvement. Now that we've established how risk pools work, let's discuss the different types of DeFi insurance available. Generally, there are two main categories: parametric insurance and traditional insurance. Parametric insurance. This type pays out a predetermined amount based on specific parameters or conditions being met without the need for claim verification. For example, if a specific decentralized application experiences a hack, anyone who took out insurance on that DApp would automatically receive a payout. Traditional insurance. This operates similarly to conventional insurance, where users must file claims after an event occurs. While it offers more flexibility, it can also lead to longer waiting times for payouts as claims undergo verification processes. One popular example of DeFi insurance is Nexus Mutual. It allows users to buy coverage for smart contract vulnerabilities, and it utilizes a unique model where members assess claims and vote on payouts. This creates a community-driven approach where everyone has a stake in the system. Now, let's talk about some compelling benefits of DeFi insurance. Accessibility. Unlike traditional insurance, which may require extensive paperwork and verification, DeFi insurance platforms are typically open to anyone with an internet connection. This is a game changer, especially for individuals in regions underserved by traditional financial systems. Transparency. Because DeFi insurance is built on blockchain technology, all transactions and processes are visible to participants. This transparency fosters trust, as users can independently verify the operations of the insurance protocol. Lower costs. By removing intermediaries, DeFi insurance can often offer lower premiums compared to traditional insurance. This is beneficial for users looking to protect their assets without breaking the bank. However, it's important to note that DeFi insurance is not without its risks. The technology is still evolving, and there can be vulnerabilities in smart contracts. Additionally, the regulatory landscape is still unclear, which could impact the future of these services. While DeFi insurance is promising, it also faces several challenges that need attention. Volatility. The cryptocurrency market is notoriously volatile. A sudden drop in asset values could affect the solvency of risk pools, making it difficult for insurance protocols to cover claims. Regulatory uncertainty. As the DeFi space grows, regulators are trying to catch up. This uncertainty can lead to hesitance from potential users who are unsure about the legality and reliability of these services. User education: many people are still unfamiliar with how DeFi works. There's a significant need for education around these concepts to ensure users can navigate the landscape safely and effectively. So, to summarize, DeFi insurance is an innovative approach to risk management in the decentralized finance space. By utilizing risk pools and smart contracts, it aims to offer a more accessible, transparent, and cost-effective alternative to traditional insurance. However, it's essential to understand the risks and challenges that come with this new frontier. If you're interested in exploring DeFi insurance further, consider researching platforms like Nexus Mutual or checking out other DeFi insurance protocols. And remember, always do your own research before diving into any investment. Thanks for joining me today. If you found this video informative, don't forget to give it a thumbs up, subscribe to our channel, and hit that notification bell so you never miss an update. Have questions or topics you want us to cover? Drop them in the comments below. Until next time, stay curious and keep exploring the exciting world of finance.